Hey guys, I'm Duncan Wilson.
And I'm Sasha Syed, and you're listening to the Mortgage Sweet Spot Podcast, proudly presented to you by Mortgage Suite.
This podcast is your go-to source for expert insights, innovative strategies, and the latest mortgage trends to help you make the most informed decision regarding your mortgage financing. Whether you're a first-time home buyer, a seasoned real estate investor, or maybe somewhere in between, you've come to the right spot.
So sit back, relax, and get ready to discover your mortgage sweet spot.
We're back.
We are back, baby.
Cool thing. Hey, quickly before we get into today's topic is really massive, but did you ever get a call back from your CTV thing that you did? Did you end up getting on there?
I did, yes. I didn't get on the video.
Oh.
They used like the most handsome guy in the world from Rocket Mortgage. And I'm sure if I looked like that guy, they would have used my video too.
Oh my God.
They did put a couple of my quotes in the written.
Oh, that's good,
part.
buddy.
So I did get a little bit in there. Yes.
I like that, man. That's pretty cool. Sasha was on CTV. He was giving some question answers. What was it mainly about?
It's about the rates going up. He asked me a lot about like what I'm seeing with my clients. I think that's why I didn't really use my video, because I only had 2 renewals this year.
Yeah.
And so I didn't really have much to talk about on that, but they used my, my quote where one of the questions was, what advice do you have for people with renewals coming up right now? And we mentioned in a previous episode where people need to start looking at their credit, reviews 6 months to a year out before the maturity date.
100%.
So they put that in there.
Okay, well, guys, if you want to see those quotes, go to the CTV website and you can see Sasha's quotes. But maybe next time he'll be on the video camera for you guys too, because he's on our video camera here, and I think he's pretty handsome. Okay, so today, what we got here is, and it's an article that we wrote a long time ago, and it's something we try and teach a lot of new agents coming in the market, but the borrower types. So I'll just begin off, and I'm going to throw it over to Sasha here, but I will begin with the borrower types that I used to use when I first started in the industry, and it was called AAA. That's all I had. All you had, I came from a bank, so you went into mortgage brokering or mortgage agency, and you had this one product you sold, which was AAA. And I'm not kidding you, back in 2009, every one of these borrowers fit into AAA. 600 beacon score, you're getting the same rate as a 750 beacon score. Oh my God, you're 601. Don't worry, we got a product for you. It's the same as the 860 beacon score. And it was all driven by beacon score, which is credit score. Okay, guys. But I would say now the market's kind of broken up, and it's broken up into 5 to 6 borrower types. And this all happened, guys, by the way, in 2008, 2007, 2006 in the U.S. market when the FICO score started being affected and liquidity in the market was really a big situation, meaning there was less liquidity. So now you're noticing with less liquidity, money becomes more expensive. And when money becomes more expensive, they break down these borrower types into different buckets. So no longer is AAA the situation. So Sash, let's go into it, man. What do you notice about these 5 different borrowers? And if you want to mention to these the people listening, what are the 5 to 7 or 5 to 6 different borrower types? What do you got?
Sure. So the borrower types, like you mentioned, AAA starts with that. That's your prime borrower. There's an Alt-A space, and then there's a B space, and then there's private lending, and then there's what's called a MIC, which stands for Mortgage Investment Corporation. So a MIC is basically a pool of private investors that are just pooling their funds together, where a private lender would just be maybe an individual or, a couple of individuals
like
getting
great
together.
Uncle Frank.
Yeah, right.
Like, hey, can I borrow money for free? Oh, what's that? You want 12%? Okay, Uncle Frank. All
okay,
right.
and a piece of your house. So there are 5 different borrower types, and we'll jump into those. So, well, want to start with private and
let's
lending?
go. I'll go with we'll go from the top. So everybody thinks that they're a AAA borrower. And I'll be honest with you guys, all of you are AAA borrowers to me and Sasha. We love you. We strive every time to do a AAA borrowing application with you. The only problem is 99.999% of the time we're getting declined these days. And the reason why we try these AAA situations is because we get paid by the lender to do that AAA mortgage for you. So AAA, that includes your insured product, which is CMHC, Sagen, or Canada Guarantee. Those are the 3 insurers. AAA includes you having an insurable rate, and I will not go into all the nuances of insurable and insured and all that. I'll just let you know you get the sexy rate, okay?
Yeah.
The next one that Sasha mentioned is alt product. Now, alt product is 20% down. You can't do an insured product with an alt, meaning you can't put 5, 10, 15% down. You got to go flat out 20%. And what the alt product does is allows your ratios to kind of be altered a little bit, right? So and I'll go into talking about these ratios. Sash, what's ratios? Talk to these people about ratios for a minute. Man.
Absolutely. So when we're talking about debt service ratios, a mortgage application is qualified by two things: your household gross annual income versus your GDS and TDS ratios, which is gross debt service, which is your living expense, your property tax, heat, and your mortgage payment. And your total debt service is all your GDS, including your monthly liabilities. So credit cards, car payments, mortgage payments, stuff like that. Things that are not included in that would be like your insurance payment, or stuff like that, right? So,
yeah.
But, and when you're insured and you're in a AAA, you cannot exceed 44% of your total debt service and 39% of your gross debt service.
And that's based on gross income, guys. So
yes.
Just to give you an example, if you make 60 grand a year, your gross income per month's 5,000. That would mean, I don't want to do the math here because I don't do what's 44% of $5,000, like maybe 3,200. So if you get to 40%, let's say 44%, and you're riding above that 3,200, in this example, you're over your ratios, which means, obviously, Sash,
then you got to go look at an Alt-A lender or a B lender. And in these spaces, you can extend those debt service ratios maybe up to 50, 55, even 60 and 60 in some cases.
Yeah.
So the big difference between a prime lender and a B space lender, you're going to have to pay for that. I mean,
exactly.
If you got debts, you got stuff going on, you're not prime, you got to pay for it, but we get things done. And then some of the lenders actually have a graduating program where you can go from B to A as long as you qualify, but you don't have to see us again. It's something they can do internally, like First National has that.
But also, please come into us because we could probably get you that better rate after 2 years of being in with a B lender. You want to graduate to A, come in and chat with us. We'll do our best to get you the graduation program as well.
Yeah.
To be honest, I wish it worked with like, hey, Sasha, you're a really risky borrower. We're going to give you a really lower rate so you can afford that risk. But problem is it's the opposite. So when we say B lending, it's obviously not as cool as A, I guess, in our industry, like A, B, C, and it goes by these letters. So C lending would be your private lending situation, B lending. So I won't go into too much of this, but B lending does include your stated income or cash flow lending. And we will definitely, Maddie, you want to write that down because that's going to be our next podcast. What is cash flow lending and how does it work for everybody out there that wants to gross a boatload of money and claim next to nothing to CRA? Now, there's nothing wrong with that, guys. I won't tell you the truth. That paying taxes sucks.
It sucks.
It does, right?
Yes.
Yeah, like it sucks. But honestly, if you're going to reduce your income, you are a risky borrower. And what in that sense is you're going to have to go be lending where we can use and do a little bit of finagling with the numbers in regards to what is your actual income and what's your cash flow that we can present to the lender in that case. So I'm going to repeat it here, guys. You got AAA, you got Alt-A, then you have B lending, and then you have the M.I.C and private lending. And there is a couple of M.I.C. We won't mention their names on here, but there's some M.I.C that are pretty cool. What does it take to get into a M.I.C? What's their ratios look like, Sash?
So M.I.C are actually all the ones that I have experience with didn't really have any debt service ratio requirements. They don't look too much at your income. They're more of an equity-based lending. So if you have the equity available in the house, they're more likely going to loan to you. If you're like in a rural location, they might only loan up to 65% of the value of the home. But if you're in a more urban setting, you might be looking at more of a 70-75. So it is a bit lower of lending, but they're not looking at your income so much at your credit stuff. So it's good for that kind of stuff.
Yeah. And I would say across the board, when Sasha looks at these loan to value, he's talking about loan to value. Every single lender nowadays is looking at pride and ownership. Okay. I want to talk about pride and ownership for a couple of minutes here. If your house is not, well maintained, you don't clean it up, you don't make it look nice, it doesn't present well in the market, the lender now looks at that going, and I'm talking AAA all the way down to a M.I.C or a private, they're going to say, this guy doesn't have pride and ownership, this lady doesn't have pride and ownership, we don't want to lend on that. And that's where me and Sasha will walk over to your house, we'll do some cleaning up in there and do some landscaping for you if we have to.
Yeah, for sure.
But please, guys, remember pride and ownership because it does reduce the loan to value that you spend. Now, when Sasha was saying about the M.I.C, I've dealt with some M.I.Cs that go to 75 TDS, 75 GDS. Now, what that would mean is you might want to be on a steady staple food diet there because you cannot afford groceries.
Yeah.
You might want to move your mom in. We can use mom's income as supplementary income. But at 75 GDS, TDS, guys, you got to remember that's taking up 75% of your gross income. And let's just look at what the government's taking from you based on that income. 35, maybe 25% in income tax. So in essence, in our beautiful Canadian market, we have lenders that will go that high, and we have tax levels that high by the CRA that literally your living expense is 100%. So if you're in that situation, give me a shout. I'll get you a gift certificate to Armando's Pizza.
Yep.
And we'll get you a pizza so you can eat. But I'll be honest with you guys, it gets expensive as you move up the ladder here. Like AAA, it's really cool right now. The AAA rates, and I hate quoting rates on this because they change. Like literally, as soon as I say this, the rate will change.
Yeah, they are forever changing.
Yeah. So it's 4.84, 4.99, 5.09, somewhere ranging in there. That's AAA. When you get into Alt-A, you're looking at a refinance possible rate, which is around 5.6, 5.44 discounted down. And then when you look into B lending, you're floating higher above than 6 sometimes. There is some premium rates at 5.99, 5.94, but right now in today's market, as of June, what is it, 12th today?
June 12th.
June
Yep.
12th, 2024, you're probably looking around probably 6.24%. Now, the difference is where we can save you some cash flow, because everybody's like, oh, well, that rate's too high. That's cool. That means my payment's going to be higher. Not necessarily when we look at amortization. And the funny thing is, when me and Sasha, we didn't record this conversation before going into this beautiful podcast today, guys, but I was letting him know a lot of clients are sitting with a 20-year AM, 15-year AM mortgage right now with higher payments. And I find a lot of times it's better just refinancing the whole thing out to a B lender with a 6.69%, but a 35-year AM payment, right? And have you seen that recently, Sasha? Like, you seen that at all?
I mean, recently I did do a debt consolidation where they were in a pretty low rate. I think it was like 2.3. And we were trying not to touch the rate, but they just had so much debt that we looked at maybe doing a HELOC and paying it off of there. But the interest only payment was so high on top of their mortgage payment already that we did just end up taking them out of their prime rate, putting them with a B lender for 1 year. And, we're just keeping in touch to get them going back to the A. And funny enough, I just chatted with them. Everything seems to be going well with them. So a good agent, if you're dealing with debt, will check on you every few months to make sure that you're maintaining your debt and make sure that you have your income going, and we'll get you prepared to go back to a prime lender, get you back in that lower rate, get you back to that lower payment. So if you haven't heard from your mortgage broker recently, give me or Duncan a call and we'll figure it out.
Yeah. So yeah, going back to that, I like that. They should give us a call, because I'm not going to lie, we do it better than anybody else. Let's just talk about that. Like Sasha's just talking about this mortgage situation. That's called a mortgage plan, guys. And it's never going to be the same. Not everybody's going to fit into a AAA mortgage like back in 2009 when I began. They're going to fit into different buckets. And our best bet is here. And our whole slogan for the company here is your path to a better mortgage. It is sometimes a big, long path. It takes 3-4 years. Someone has to be now trained on how to get better income, trained on how to actually build their credit score back up. They have to sit down with me and Sasha and go through the plan as to, okay, this is what we're going to do for this year. We're going to go into this M.I.C, get you sorted out, build your credit back up. And then what we're going to do is get you out of that M.I.C into a B lender if we can't, get into an Alt-A lender. And sometimes it takes maybe 1 to 3 years. Finally, you're sitting in the third year and you're heading into a nice, beautiful prime rate, and you have a 5-year fixed rate mortgage. And that way we don't have to talk for 5 years. I mean, I hope it doesn't come to that, but at 5-year interest rate that we used to give out, everybody got it. Nowadays, it's more like, okay, let's park your mortgage here for 1 year and then move it to the next place as well. So guys, just remember, there is more borrower types than ever nowadays. Mortgages are more confusing. And the reason why I'm saying they're confusing is because of the amount of calls I get in where a client thinks they can afford a $600,000 house and they make $34,000. And like, give me an example recently, Sash, like what you find as well, buddy, like in regards to just how confusing mortgages are for people, let's say, because of these types of mortgage borrowers.
Yeah. So, I mean, I'm finding that people in general are just confused with the entire process. Like even like collecting docs. I've had somebody ask me, why do they need a job letter? And it's like, you have to show proof of your employment. And he argued with me that why isn't T4s good enough? So the whole process can be confusing, especially with the way the market has been with the rates and everything's changing. I've noticed that when the rates change, then guidelines change. So, I mean, you just have to do the best job you can to like guide your client along the process, make sure your communication is on point, and just ask them and let them know that there's no bad questions. If there's something that you don't understand, it's our job as the mortgage agents and brokers to make sure they fully understand what they're getting involved with. And on that, I've found a lot of people this year coming to me trying to get out of private mortgages. They don't even know why they were put in a private mortgage.
Oh, I find that out. That's a lot.
So if you're facing if you got an agent or a broker telling you have to go private,
really,
yeah, get a second opinion because maybe you don't. Nothing against other agents or brokers, but maybe they're just want to get things off their plate quickly, and that's the best way to get you off their plate. Or so I would say definitely check with us, get a second opinion if you're looking at something like that.
And what Sasha's talking about there is suitability. Is that private mortgage suitable for you? Another point I want to make is what I do is I under promise, over deliver. So a lot of my clients, I ask for blood samples, and the client's going, why do I need to provide that? And I'm like, oh, never mind. We don't need blood samples for you. We just need a job letter. So
that's a pretty big jump.
Yeah, right. Oh, you know what? They waived. The lender has waived your blood samples. You're good. Just provide me a job letter, 2 pay stubs. Make sure if you want AAA, make sure those pay stubs show the 40 hours a week that you're claiming on the application. Because as soon as the lender sees your pay stubs that we look over, and we do call you guys and say, okay, listen, you said 40 hours a week. How come this says 31 and how come this says 22? Then you find out from the client, oh, well, I took 2 weeks off and I don't have to work 40 hours. Guys, that has to stop. We need you to work the proper hours to match the pay stub if you want the AAA. And everybody wants the AAA. And I get it. But sometimes the solution is let's go B first till you get situated. Okay, guys? Other than that, I can repeat the 5 borrower types, but
I got a question for you. So some people that might be coming out of consumer proposals and bankruptcies, how does that work with them to fit into an A lender or a B lender? Like, they might be wondering about that.
Okay, so the 222 rule, guys, what it is 2 years post discharge. So I went bankrupt in 2021. I did a dividend payment, and I basically paid my dividend over the course of 12 months. By January 2022, I'll be given a discharge paper. As of 2022 January, I'll have to wait 2 full years, January 2024, in order to go apply. Now, make sure that before the day you got your discharge letter, make sure you go get a Visa card. And make sure you probably get maybe a Canadian Tire or a Capital One, because you're going to need a bank card, credit card, and a retail store credit card. It most times works. And what they have to show is a $2,000 limit and 2 trade facilities. So that's why it's called the 222 rule. There is, by the way, guys, I'm not going to lie here, B lenders. There is certain B lenders that don't make you pay out your proposal when you go to redo your mortgage too. They allow it to keep going on, which is sometimes beneficial because you got to remember your proposal comes with no interest. It's just an actual payment back into the system. It could be 3-5 years. We'll go into more, Maddie, write that down, podcast on BK proposals, and maybe we'll bring in a beautiful guest with us that deals with bankruptcies.
Perfect.
But at the end of the day, always remember the 222 rule. There is some exceptions on it, guys, but I'll be honest with you, there's not too many exceptions. Like there's a couple we can try and fight it. If you're coming due on the second year, the 2 years after post-discharge, I would start looking for a house if you're looking to buy, because it does take a little while. Like Sasha says, come in good 3-4 months, get pre-approved, go through the program, go through the mortgage planning process, get a pre-approval certificate. These are all things that are stepping up. There is so many clients that we have that literally call us saying, hey, bought a house cash. And you're just like, all right, well, where are you at? I just bought a house cash and I claimed bankruptcy 2 weeks ago. And you're like, oh, well, why'd you do that? Like, what down payment you have? Well, I don't have anything. Is there a way we can do a rent to own situation? And it's basically that kind of client. We're trying to help, but at the end of the day, sometimes we're just like, oh my God, why did you do that? Why
Yeah.
who put you into this purchase offer, and why did they bring you around? I would say all realtors out there, please get your clients in front of a broker and agent and get them pre-approved. Get them into their bank if they want to. I don't mind. Wherever they want to go, just get somebody that runs numbers and looks at these ratios, looks at the credit score, and looks at the amount of the down payment.
Yeah.
Maddie said to start wrapping up.
So in conclusion, there's 5 borrower types. You know, you got your A, your alt, your B, and your private lending and your M.I.C. So if you feel like you got some debt going on, or you know you just want to know where you're at, you got a renewal coming up, and you want to know if you're in a B lender, if you can get over to an A lender, like just come and chat with us. We'll have a look at the whole situation, and yeah.
I'm gonna just double down on what Sasha said. I like that. It's true. And eventually one day we'll probably have a little quip, like a little song for the 5 borrower types. These are the 5 borrower types.
You got a AAA, you got an Alt-A,
you got a B lender and a M.I.C and a private. All right,
a boop-a-doop-a-doop.
Skibidi dop top. All right, that's it, I guess. Thanks a lot. I hope you guys remember the 5 borrower types. Call us if you don't.
Thank you.
Ladies and gentlemen borrowers, thanks for tuning in to the Mortgage Sweet Spot. If you have any suggestions for upcoming episodes or questions for our hosts, me and Sasha, throw them in the comments below.
And if you enjoyed the podcast, please subscribe to our channel on your preferred platform. We're available on Spotify, Apple Podcasts, or you can check us out on YouTube. Once again, thank you for tuning in, and we'll see you on the next one.